there. Welcome to the Growth Whisperers, where everything we talk about is building enduring great companies, building companies that matter, companies that last, companies that people want to work in, you know, the kind of companies that we all aspire to being a part of in one way or another. My name is Brad Giles, and as always, I'm joined today by my co-host, Kevin Lawrence. Kevin, hello, and how are things in Canada today?
Things are great today, Brad. It's in the evening. It's getting a little dark, and but it's not getting dark as early, and we're really happy about that. So yeah, things are good. Economy's booming. COVID has allowed a lot of restrictions, masks almost nowhere except for airports, I think. So yeah, life's good.
Very good, very good. Well, as always, we like to propose that people start their meetings with a word or phrase of the day. And then we tend to try to observe the awkward moment where Kevin tries to stitch them together. Oh, sorry, that was not meant to be something that I say out loud.
Yeah, that's just inside your brain. That's your inside voice, Brad. I just went outside. Yeah.
So what's your word or phrase of the day, Kev?
Yeah, it's like one I've used a lot. It's just gratitude. Like, life is pretty grand, and I'm constantly humbled and amazed and grateful for this amazing place that we live. Like, it's pretty awesome. I'm just on an airplane on a couple of days ago, and amazed at the distances that we can travel. Like, human beings are just freaking awesome. And I'm just grateful for all the great things that we do, and humbled and inspired by all the innovations. And you look at the last couple of years and how people have handled COVID, and hopefully it's behind us permanently to a great extent. Holy. So I'm grateful for the awesomeness of human beings.
Very good. Mine today is about A players. And it's just don't skip steps. So across several fronts recently, I've been involved in hiring or talking about hiring and A players, and especially through the book that I'm writing about onboarding. Like, just don't skip steps when it comes to onboarding. When it comes to A players, it's worth spending the time to get the best people.
Yep, it is. And then it's also worth spending the time to onboard them right, and then retain them and keep them happy in that process. Awesome. So what the heck are we talking about today? Last week we talked about garbage and stretch goals being garbage. What are we digging into this week?
Yeah, this week we're talking about cash reserves to weather the storms, or why you need cash reserves to weather the storms. I think in large businesses, like, you know, listed businesses or multinationals, it's kind of a bit of a given where they've got more sophisticated CFOs perhaps. But as you kind of drop another zero coming down the revenue, you know, mountain, as it were, the importance for cash reserves becomes less front of mind, and it is ever so important, because these business models are often a little bit more volatile with a little bit more going on. So yeah, we're talking about why you need cash reserves to weather the storms.
Yes, and I would propose, no matter what the size, it's a critical topic, and it's a hearty debate, because in many ways, it's almost like politics in the US. There's extremely different views, and it's almost polarizing. No, I wasn't going to start talking about certain candidates. I'm just saying, you know, the Democrats and Republicans are very different camps. And when it comes to cash, there are very different camps, except for when you have none. And when you have none, everyone's in the same camp. When you run out of it, everyone's in the same camp. But we're trying to avoid the crisis that rallies people together and figure out, you know, and this is, Brad and I have a view, but we want you to think about what we talk about today from a perspective of enhancing your view and pressure testing your view of how you handle cash or your balance sheet in your business. So we do have a clear view, but you may not agree with what we're saying, but use it to pressure test your thinking, and maybe it'll help to enhance your thinking a little bit. But the root of it we're talking about today is cash reserves. And there's this big conflict between the desire for growth or fast growth and a high RO, return on investment, and the desire for having a war chest and a plan B and cash reserves. And both are important. What you'll generally find is companies that have been around many decades or a few generations, they've already learned their lesson. They're all over cash reserves like you wouldn't believe.
Yeah.
Younger companies are the ones where they haven't been battle tested fully yet. They haven't been in special accounts. They haven't had to hand the keys back to the bank yet. And so sometimes they have unvalidated belief systems about this because they haven't been through the meat grinder called the cash crunch. Yeah.
And it is a meat grinder. That's a lovely way to put it. It's
the worst time, like working with companies that are in cash crunches and special accounts with the banks and living penny to penny, minute to minute in terms of cash. That is not fun for anybody.
Yeah, I've been in meetings, in quarterly planning sessions, and from the morning till the evening, all we've spoken about is how to save the company. And I've been in those types of meetings several times. But there's a mindset that some entrepreneurs can't help but get into, which is, I need to maximize every single dollar. Like, yes. I can't have lazy cash sitting around not being used in the bank, because if I got $100,000 sitting in the bank, I'd be better off buying a new piece of machinery, employing another person, like getting that growth to happen quicker. That mindset, I can understand. Like, I've been there. I know why people get there, but it can be such a dangerous instinct to follow.
Well, it's only dangerous when you hit a cash crunch and you hit something weird. It's almost like there's studies around people that text message while they drive. And the reason it's so lethal is 92 times out of 100, you probably could send or receive a text and you're fine. Time number 93, you die or somebody else dies.
Yeah.
And the reality is it's just playing the odds. And the odds is that if you're doing that all the time or whatever it happens, it's sooner or later, it's going to bite you. And the odds are there is going to be a nasty economic event in your business sometime in the next 20 years. It could be tomorrow. It could be 20 years. We don't know, but we know for sure it's coming. Like, it's a guarantee.
It's a guarantee.
Yeah.
That's why we called this episode To Weather the Storms. Like, we know there will be storms coming. Like, no one can disagree or debate that. I mean, I know in Vancouver, you guys, Kevin, had a once in 100-year storm 4 or 5 months ago. And it was crazy. It wiped out all of the bridges going into Vancouver.
The 4 highways that take people from Vancouver to the rest of Canada, every single one of the highways was washed out and you couldn't draw it. Basically, we became an island. Now, we could, thanks to our friends in the US, we could go down south and go around through the US to get back up into the other parts of Canada. But who plans for that stuff? Right? And then never mind the pandemic and all this other stuff. It's just generally, until people have had to deal with, had a day of reckoning when they run out of cash, people are often more aggressive or don't pay attention to it as much. And at the end of the day, we're just saying here today is that we know some people love living on the edge and gambling. And others like to have cash in the bank. We're just going to talk about having cash reserves and why it's critical and give you some guidelines to think about in terms of it. And at the root of it, highly profitable companies go bankrupt regularly. It was really interesting. I had an entrepreneur I worked with in the US. He grew up in the business, no formal education. And he took over, bought the company and took it over after, working on the floor, got it up to 100 million of revenue and 20% EBITDA. So 20 million of EBITDA on a $100 million business is pretty damn good.
Yeah.
Well, I did a workshop for him and his team. I got a call from him one day. And he called and said, Kevin, I really need your help. I go, what's going on? Well, I'm running out of cash. I'm like, okay, that's interesting. What's going on? Oh, I don't know what's going on. And he wasn't that sophisticated in terms of the detail. I said, well, get your CFO to put some numbers together. Okay, so he goes, I need to meet you. I said, I don't have time. And he goes, well, where are you? Well, I'm in Vancouver. Okay, where are you? Can I meet you tomorrow? No. Where are you going? I'm going to Chicago. Okay, can I meet you in Chicago? I said, well, I'll be in Chicago next week. I'll be in Chicago on Wednesday, Thursday. I could meet you on Friday. Okay, I'll meet you on Friday. And I get a confirmation. He booked us into the Trump Towers, which is the Trump Hotel in Chicago, which is spectacular. Anyways, he flew in on his private jet. His driver brings him to the airport. Like, he's not, underperforming as a company. Anyway, long story short, at the end of the day, he normally operated on about 7 million of cash, and it was all gone and going the wrong way. And he was terrified. Turns out he made a deal to save money on a major resource he bought in his business, but he shortened the payment terms from 60 to 15 days. And if you take a $100 million business doing 20 million of EBITDA and you break down the math, that's about 6 or 7 million bucks that vaporized. Mm-hmm. The point of it is that he actually had an okay reserve, but he just didn't understand cash that well. And he was going to lose the business. He was going to have to go and get external equity because he literally couldn't pay his bills. Right. And this is what happens with cash. Cash is something that a lot of people don't understand well. And what we want to talk to you about today is that, good companies go to business because they don't know how to manage it. So what we're going to say, and we don't know your business, your operating conditions, whatever it is, but somehow my recommendation, whether it's 3, 6, 12 months of operating cash, at least within 30 days, you need to guaranteed be able to have probably 12 months of cash. 12 months of cash, maybe not available in pure cash in the bank, but you can get it no matter what the economic conditions are within 30 days in your hands.
Because the storms always come.
Yes.
We started off talking about the weather, but every year there'll be a winter. Every year there'll be storms. Some storms will be worse than others. And it's just a gamble. And the gambles might be exciting, but we're about building enduring great companies. The companies that don't survive never get to endure and tell their story. Like, they're gone. They disappear, right?
Yeah, they get bought up by somebody else along the way.
Or whatever happens. But your point there, right, is that profitable companies, it doesn't matter your business model. It doesn't matter how many A players you got. Profitable companies run out of cash and go bankrupt every single day. And that's the importance of having enough cash to weather the storms. You've got to be able to weather those storms to survive, or else there'll be nothing. There'll be just nothing. I've been in meetings with people where we're talking about a brilliant strategy, and they go, that's fantastic, but really what I've been thinking about for the last 10 minutes is how I can't make wages next Thursday.
Yeah.
And it's like, it doesn't matter how good your strategy is, how good your team is, everything will come back to cash.
Yes. So we want to encourage you to have your target of what you think it should be, not what you think your model can do, what you think it should be. And, we both push people to build up cash in their businesses for the privately held, family businesses that want to be around for a long time. We'll talk about private equity in a minute. Private equity has a different approach to cash, which works because private equity has a lot of cash. They generally run businesses with maximum debt, minimum cash, and it creates a psychological environment where the team has to produce. But the private equity always has access to cash, so they've got backup plans if the operators. So it's okay for the operators to not think they have cash, but someone has to have it aside from just the bank. So I want to give you an example of something in the auto industry called service absorption rate. Basically, it's the service or the fixed operations part of a car dealership. The parts sales, the body shop, the service shop that fixes your cars. And service absorption rate is the ability of that part of the business to soak up the overheads of the entire automobile operation. Meaning, if they couldn't sell any cars, 0 cars, which for some dealers has been coming almost true, not 0, because they can't get inventory right now in this market. It's hard. But if they didn't sell a single car, could the service or the fixed ops cover the nut so the business could break even? So that's called service absorption. So the auto industry has that, a target, typically a healthy auto business would be about 85%-ish. When companies we work with, we want to push past 100 to know that we can cover that and be healthy without selling a car. And that's another version. It's like, it's in the same direction as a cash reserve. Although, one of the auto businesses that I worked with in the past, not only would we have a service absorption rate of at least 1, we would also have large sums of cash set aside. And when we would need to do projects, we would go borrow the money from the bank. So we have our big war chest. And then we go borrow money when we need it, because the business was generating great cash. But we would borrow the money because then if something came along that we wanted to do, we can go and use our money. We don't need the bank's permission, right?
The bank is a partner in a business that's strong, like
a fair weather friend, we call them. Yes.
Yeah, like we don't. The bank should be viewed in that we don't need them, we want them. Okay, we're not necessarily like our business won't collapse without them. Like we've got to be able to, because it was only 10 or 12 years ago that a whole range of banks, they themselves went under, and their job is to manage cash.
Yes.
Right. So and that was a storm, a big storm, but that was a big storm that had a lot of impact on people. So we've got to have a strong enough business that we can withstand that shock. I remember there was a customer that I was working with many years ago, and every month I'd say to him, what's your capital target? How are we progressing towards and how are we going? And we set an amount of money and we put it in there. And I think he took the advice, and I think that he took the concept. And then I remember distinctly a couple of years later, it was a Saturday morning, and I was at the farmers markets with the family. We were walking around, and he rang me, he never rang me on a weekend. And I thought, I better take this call. Picked it up, and he's like, it's all just collapsed, and it's all collapsed. Like, we've got some real problems. In the preceding months, he was telling me how this major competitor went under, that major competitor. The industry had structurally changed. And if we hadn't been saving up that cash when the industry had that structural change, he would have been wiped out. Now he's gone on and he's going fantastic. But it was only because we changed his thinking and said, we've got to have a pool of cash that we can draw on in case we have to weather the storms.
Yeah. Or sometimes it can be acting on a big opportunity. Warren Buffett, who's known for having lots of cash, is also known to get some amazing deals on businesses because he can have a discussion today and send the money tomorrow because he has it. He's not needing to get permission. And so it's an opportunity chest as well, not just problems where you can move and you don't got to worry about finding, because sometimes there's amazing deals that come along. And if you have cash, you can act no matter what the economy is. Okay, so we got some points to think about. So we understand the point. And again, every business is different. You just need to have access to it, guaranteed in some way, so that you're not going to end up giving the keys to your business to someone else to run. So number one thing to think about from this is that cash allows you to stick to your plan and your values when things get weird. Weird things happen all the time, and you can stick to your values and stick to your plans. One of my clients in the Middle East, when things went 05, 06, the market crashed bad. Like, real estate fell 50% in 3 weeks. It was insane. It was the most insane economy I've ever been in, which this economy kind of reminds me of it. Anyways, but I remember is that we're in a meeting deciding what to do. I mean, and business fell dramatically, and we were able to stick to the values of the company, which means our last option was to lay people off. right? We had a whole bunch of plans because the company was about taking care of people. Interestingly, the company got tremendous benefit from that in the future because in the market, people were slashing jobs like crazy. And we ended up with a reputation of handling ourselves like true professionals and taking care of our people in a really tough time.
It's a really different conversation going to the workforce and saying, we've run out of cash, we need to lay people off, compared to we're losing money, we need to figure out how to recover. And we're not going to lay people off, and it's going to help, and it's going to mean that we're losing money. But in order to save these jobs, we need to turn this ship around.
Yes. So number two is that, scarce cash does lead to creativity. But if you are so scarce that you can't do payroll and you can't pay the bills this week, everyone gets focused on by the minute and just surviving, and generally not how to build a great business. It starts to create small thinking and survival thinking. So there is a benefit to a certain point, but when you're running day to day, hour to hour on cash, nothing good happens. And a huge amount of energy gets wasted just trying to balance the dollars and the pennies and the nickels to stay in business.
This is what we were saying at the beginning of the pandemic when we started this podcast, is what happens if 80% of your revenues disappear? That's a storm, right? And for some people that happened and some didn't, but it's, only the prepared will survive. So, having that scarce thinking, like you have limited options. What we want to do is say the cash gives you the options when the storms come, and they will come.
Yes. And when the opportunities come too. The third thing, even in private equity, even though they run companies maxed out balance sheets and minimum cash, but they always have access to more because they're capital organizations. So the operators, as I mentioned earlier in the show, the operators are operating on very tight, in very tight lanes and very tight expectations around cash, but there's more in the system, and there's that balance. Again, even with private equity, if they get too tight and they're not thinking they're going to be able to stick to their covenants, then everyone gets short-term thinking, which is not, or too short-term. But there's a balance, and somewhere there's, but in the case of private equity, there's always.
That's how they run their business. That's how run, and in private equity, the companies that they're investing in, like they're the product.
Yes.
So your business is the product if you're backed by PE or VE or VC.
VC, yeah.
The way that they run their business is deep cash reserves.
Well said.
So they can endure.
Yeah, so let's talk about the cash. Like, what is this? And I've had lots of discussions with different people about this. Lots of clients, because you and I both have clients that have been in business for decades, enduring great companies we work with a lot of. It can be in many forms. It can be pure cash, right? And in my mind, basically, it's 30-day cash is what I like to call it.
Yep.
So it can be pure cash. And, you might, as you get bigger, you need to get someone to manage your treasury and decide where you're going to put it to get the reasonable return based on what the use is. It can be personal assets that you have. If you're an entrepreneur and building it, and you run your company fairly tight, you like to pull the cash. Maybe you've got it in investments or other assets that you can access it. The other one, one of my clients said they have a notable business, and they use as much as their cash they can in their operations. They don't leave a lot in the operations, but this entrepreneur said, look, at the end of the day, I have a whole bunch of assets my business owns that I can always convert to cash, and a bunch of it's real estate, in 30 days. And I always have either assets with almost no financing or no financing on it that I am 100% in control of. I have no partners, no anything. And I can easily, even, if the asset's worth $20 million today, and in a horrific economy, it's worth 12. And even at moderate leverage, at 50% leverage, I can get $6 million within a month. Today I could get 15 million of cash, but in a worst case scenario, and they looked at the worst case value of that asset, and that thing, even there's $6 million there, there's $6 million there, and in 30-day terms, even though there's not cash sitting in the checking account?
Well, it's liquidity, right? It's your
Yes.
how much cash can you access in 30 days if any scenario evolves? Because maybe your bank, and this is one that we get all the time. Oh, we've got an overdraft. Surely an overdraft is okay, but an overdraft is a bank, and you look at the financial crisis over time. The banks are the ones that tighten up the economy.
Yes.
There's no, what if the bank pulled that overdraft, or what if the bank said, yeah, we don't kind of want to do that anymore? I mean, that would be,
which they have the right to, we call it a line of credit here, or it could be an overdraft. They have the right to. It's not a fixed loan. You get a fixed loan, 5 or 10 year term at a set rate, set terms. They can't pull that unless you're way off, way off, and not making your payments, etc., or meeting your covenants. But on line of credits, they can actually pull those back. They're not cash. In tough times, they can go away.
Yeah. So very specific, like a line of credit or an overdraft. This is not included.
It's not what we're talking about.
We want to have 3-6 months of cash or equivalent ability to access 3-6 months of operating expenses in a separate account, or the availability, pardon me, to get it, that isn't an overdraft or dependent on the bank.
And I would suggest at least a year is ideal, is an ideal target. But wherever you are, just make it better.
Make it better.
Awesome. So how? And one of the things that we both do is having cash accumulation targets. Like I remember one of my companies in the US, when we started with them, they were doing about 30 or 40 million of revenue and okay profit. And I remember I kept saying, we need to drive this thing, increase the profitability, but as we grow, we're going to get minimum 10 million bucks of cash. We'd have fights. They thought I was an idiot. Right now, I think they're sitting at about 60.
Yeah.
Right. And it's kind of burning a hole in their pocket a little bit. But it's like, part of it is you got to believe it's possible. And I am big for companies that don't have it on building it. And for those that have it, keeping it, because stuff comes along and you need it sometimes. I have another client that's, only been wildly successful, but in business less than a decade. And they haven't been through a downturn yet. I remember I was in a meeting with the CEO. I said, I got to sign some papers. I gotta sign a line of credit. They gotta take some of the cash out of my house. We're a little tight on cash. And I lost it on him. Like, what do you mean? In a booming economy, in a booming business, you're borrowing money against your house? Like, I think I told him he was an idiot. But I love the guy. Don't get me wrong. But it's like, if you in this market need to borrow money against your house because cash is getting too tight, you're making bad decisions. Like something's wrong because it was a surprise. It wasn't planned for. It wasn't a strategic move. And I'm like, yeah. Anyways,
if that scenario was because he was going to acquire a business that was at a discount, you could maybe justify it. But I'm not hearing that.
No, and his backup capital is his house. He hasn't been in business long enough to pull a lot of other cash into other things. It's all tied up in his business. Anyways, now we had amazing debates and discussions with the CEO, CFO, and we dramatically over the last 9 months reworked a bunch of the capital and fixed things. And he's now got a strategy. Actually had him talk to a number of my other clients in similar industries about their capital strategies. People have been around 30, 40, 50 years. And
so that company that you said they've got 60 million cash and is burning a hole. So what's their revenue, give or take? Like, is it 60 or is it 500 million or 700?
It's closer to 500. Actually, it's just under 500 million.
Okay. So for context, for listeners,
that's 10% of revenue.
That's about
or equivalent
10%.
to 1 year's profit.
Yep. 10% of revenue, or about so that gives a bit of a frame that people can begin to think, okay, well, I'm doing 20 million, therefore 10%, they can begin to think about like that, because
that would be an actual reason, an interesting benchmark. Like, a healthy year's profit.
Yep.
Or I would prefer a year's OpEx, but
Yep.
you figure out your own. Because smart people listening, the point is it's substantial.
It's probably more than you think, because most people have about 2 to 3 in small, medium business, have about 2 to 3 weeks of cash availability. Yeah. And as soon as something stops, all the gears grind to a halt.
Yeah, exactly. And then finally, the second piece around how is the levers is you got to learn about cash conversion cycle, and you got to learn about cash flow. There's some great stuff. There's a wonderful article. How fast can your company afford to grow? It's an HBR article, and learning about cash conversion cycle and where cash gets buried in your business and locked up, whether it's in your business model, how you operate, whether it's in inventory or things like that. We've done work on this with companies, and it's magic how much cash we can unlock. And probably I did math going back probably 5 years ago. I think at that point we'd unlocked $186 million of cash, like taking it from being buried in operations and putting it back into bank accounts in different companies.
Yeah.
It's just shocking. Like the client I told you about, the private jet Chicago meeting, where he met me in Chicago. In that case, we swung it. He swung it the wrong way by 7 million. And with just understanding cash conversion, we swung it back ended up being by $7.2 million in a matter of about 4 months.
So it's measured in days, but you think, if I improved it by 2 or 3 days on average across the business, like it's only a couple of days. That's not that much. We had one example is about $20 million business. We brought it back, I think it was 3 or 4 business, and produced about $2 million of cash. So really, really quickly, the average across the board can be massive.
It is, but it's learning the levers, where it gets buried and how to speed it up. And you track it in days because it's simple.
Yeah. And
it scales with your revenues. And anyway, it's game changing if cash is tied into it, because unless you're a SaaS business, almost everything, or you're a SaaS software type of, almost every other business should generate cash. They should, if they're well managed, and many are not well managed and don't, but they should be generating a fair amount of cash on a regular basis. And you need it if you're going to grow. So learning about cash conversion, and also how it relates to growth, and how you might change your business model to make it more effective. So a quick review. The whole idea here is to think about cash and what's the right amount of reserves for yourself. Think of what some of the worst case scenarios that could come up. And like the car industry, we have no cars, or we can't sell any cars, but we still break even because our service, our back end, or fixed operations covers the nut of the overhead. And cash allows you to stick to your plan and stay on track to your values when things get weird. Running too scarce allows people to scarce thinking, and that takes away growth and takes away people's willingness or ability to take risks. And even in private equity, they have lots of cash. They never fully run without cash. So they have backup plans, even though their operating companies sometimes have no cash in them and fully leveraged balance sheets. The mothership's there to help. Want to do number 4 on there, Brad?
Yeah. If you didn't have access to your line of credit in 30 days, how much cash could you access? For example, if the bank closed your line of credit, or shut that down, what is the total amount of cash that you could access? That's what we're talking about here. And it's got to be enough to keep the business running, to weather the storm. Because the line of credit doesn't count, because it's not guaranteed. And then I guess next is setting a big cash accumulation target, and then keeping that cash in a separate account or away from operations, some way that it can't get sucked into the working capital of the business, and so that it truly is about weathering the storm. Because we know in a contracting economy, cash becomes scarce. And then finally, understanding the cash conversion cycle days. How fast can your company afford to grow was the HBR article that Kevin mentioned from Neil Mullins. And then make the changes needed, make small sort of changes all along the way. So, Kevin, would you like to move to close us out?
Yeah. So the whole summary is learn more about cash and how it operates, how it works in your business, and build it up to have it for opportunities or weird storms that happen. So this has been the Growth Whisperers. Thanks for listening. If you want to get the YouTube version, just search the Growth Whisperers at YouTube. Brad and I both have awesome and informative newsletters that we put a lot of energy into. If you want to read them, Brad's you can get at evolutionpartners.com.au. You can also contact him there. And for myself and our firm, Lawrence & Co., same thing, lawrenceandco.com for our newsletter, or just get a hold of us if you want some help. All right. Have a wonderful week. Cash is king. Have a great one.